to 9 a.m. start. I'd like to begin with a couple of introductions. On the mayor's team, to my left is Lisa Chan, who has joined us as a senior investment officer and will be focused on real estate and real assets. And I think many of the trustees know Ray Sorolla, who works with Carolyn Wolpert on benefits and governance issues, joins us from City Hall as a senior policy advisor. And I know Callan would like to make some introductions.
Yeah, thank you, Ranji. Over on the bench, where Anushka often sits, Bud Palecchia is sitting. And I've gotten around to a number of you. I apologize if I didn't get to some of you this morning, but I had proposed introducing Bud into the consulting team relationship. I've been thinking about this for about the last 6 months or so, because, as I don't think any surprise to any of the board members, there's been a substantial amount of work that we've been involved in, I think to even a greater extent than we have in the past. And so on a purely additive basis, I wanted to bring another senior consultant into the relationship. This doesn't change my role. It doesn't change Anushka's role. We are still here and still will be. But I do think that both for meetings as well as for quite a bit of the work that we do, I thought it was important to bring in another senior person. NYCERS has always been our really one of our very largest and longest standing relationships, and I want to make sure we continue to do what we've done for you in the past. Bud's background, so that you know, Bud and I actually worked together. His first job was at Prudential. We worked together for a number of years when we were both there. And back in 1999, I hired Bud to come into Callan. Bud was with us until early '07 when he made a brief detour over to one of your managers, Amalgamated Bank, where he worked for a couple of years, but we were able to convince him to come back. And so Bud has, as I do, quite a bit of experience with public pension funds, with jointly trusteed pension funds, and I think is going to bring a good amount extra to the table. I guess the point I want to leave you with is, again, this is additive. We're not making any changes at all. I think Bud and Anushka will be at meetings as you see now. It gives us some additional flexibility in that. I'll continue to be sitting here at the table, but bringing in a lot of extra work capabilities along with our specialists in San Francisco as we need them. So I wanted to make sure I got that in front of all the board.
All right, welcome.
Thank you.
Larry, over to you.
Thank you.
Oh.
Here.
Here.
Public office.
Here.
Governor's office. Borough President Manhattan.
Here.
Here. President Brooklyn.
Here.
Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx.
Here.
National Brotherhood of Teamsters. Here. Transport Workers Union. District Council 37.
Here.
Okay. We have a lot to do today. A lot of good stuff, actually. But let's first review the year's results. Martin?
Yes, we're going to start with the quarterly report. We have a few extra copies here for you if you need it. I'd be happy to pass it there. One last one.
You get no respect.
So if you turn to page 7, you'll see that the June quarter ended slightly positive. For the overall quarter, the returns were ahead of benchmark by a few basis points, returning 1.15. But the real story in this report has to do with the fiscal year results ending June 30th, and those will be reflected in the next two columns, which are both the same time period. The fiscal year returns, as you see on page 7, were 23.12. We'll go a little bit into more detail in a moment, but those are extraordinarily high absolute levels of returns and was, according to our research, one of the highest returns in several decades. So congratulations, these are very good numbers for the system. As you see, going out to the other years, 3 and 5 and 10-year numbers, it's now helped lift those numbers, which the 3-year number for a while had been negative, into strongly positive territory. It's now near 5% and over 5%. and the 15-year number now well over 7%. The results were driven by the Russell 3000, the U.S. equity market that was up over 30%. Non-U.S. was up about 30%. Even fixed income contributed, although to a lesser extent. Investment grade was up in single digits, which in this context doesn't sound that strong, but is still a good return. High yield finished up over 14%, and you'll see all this in a minute. The Fed's policies in QE2 definitely helped along with the strong equity market. In fact, you can argue that those returns were helped by the Fed's policies. Turn to page 8. You see the asset allocation. The assets as of June 30th were $41.6 billion. The pie chart is getting very busy because of the diversification that's ongoing. The mix to policy weights, the overall versus the policies, are shown on the bottom, and I do want to point out that those are versus the old asset allocation policies starting next month, and that actually will be showing in Larry's piece a little later. We'll be showing the old policies and the new policies versus where the assets are. But versus these policies, we were slightly under in developed markets, over in emerging markets, and under in real estate. So I want to draw your attention to, you can skip to page 14, and in the middle of the page, under the June 11 column, you'll see how NYCERS did versus other large public funds. So I mentioned that the returns were very strong at 23.12. Well, how did that compare versus other large public funds? And the answer is it compares very well. You're in the top quartile for the year ending June, and with the strong results for the prior year ending June, if you turn back a page, you see you're now in the top quartile going out to 3 years, and those strong results have brought the 4 and 5 year numbers up as well, and the 7-year number is near, slightly above the median. But these are very strong numbers over the last 2 years on an absolute basis. Seema is here to have some comments on the equity portfolio.
Thanks, Martin. So if you turn to page 17, this just goes through the domestic equity returns versus the Russell 3000. And as you can see, just in the quarter, we're showing just a bit behind the benchmark. But if you look to the fiscal year to date, we're a little bit ahead of the benchmark, and the numbers are quite strong, as Martin mentioned, up over 32% for the year. And while the majority of the money in domestic equities is in passive, there are some highlights here on the active side where your small cap managers were up about 300 basis points for the fiscal year relative to the benchmark, in large cap, slightly offsetting that a little bit, down 100 basis points, but small cap was a highlight for you for the fiscal year. If you turn to the next page, you can see how the domestic equities are broken out among small, mid cap, large cap. And I'll just point you to a couple columns here. So the index return, the actual return, and the difference. This is just for the quarter. So if you look in the difference column, there aren't really a lot of things to point out, pretty much flattish with the benchmarks across the board. I just would highlight emerging managers, though, which is showing a 74 basis point outperformance relative to the benchmark, which is the Russell 3000, and really all 4 of the managers in the composite, Progress, FIS, Addix, Capital Prospects, showed some good performance. So next, if you just turn to page 25, we'll go through the international allocation. And there you can see this pie chart down below, and it's the asset allocation by style. And I just point out the reddish piece of the pie, which is 27.3%. That's the emerging markets piece, which, as you might remember, we're growing as a part of the new asset allocation. So we'll start seeing that number tick up even more. If you turn to page 26, this is the EFA market exposure. And for the quarter, you see we're roughly in line with the benchmark. And for the fiscal year to date, also we're roughly in line with the benchmark. We are looking to do an EFA RFP at some point in the near future, and so we'll come back to you with that as we've been reviewing our existing managers and trying to increase the performance of that portfolio as well. So now if you turn to page 31, I'll focus on the emerging markets piece. And for the quarter, you see there, we're just a bit behind the benchmark. And for the fiscal year, roughly in line with the benchmark. You might remember also that we're doing an emerging market search. We're currently in the process of working through that. We spent a lot of time with our consultant, Callan, and the other consultants across the other systems to come down to a narrowed list of managers to focus on internally at BAM, and we continue to do our due diligence, and we're hoping to come back to the boards sometime in the November meeting to present those recommendations. And now I'll turn it back to Martin.
So, like I said in the other meetings, we have the attribution for international, since it's a bigger chunk of our portfolio. Yes.
If you turn to page 34, we summarize the overall fixed income portfolio. The pie chart shows where the allocation is, and the largest slice, about half the portfolio, is the structured fixed income or investment grade program. About 30% of the overall fund, which is at the policy target, or $12.6 billion, was invested in fixed income as of June 30th. The investment grade structured program is further broken down on the next page into its three components. And if you look at the over-underweight column, you'll see we will underweight the government sector and overweight spread sectors. If you look at either the index return or actual return column, you'll see that there were positive results there, mostly driven by lower rates. So treasuries and agencies did best, returning over 3%, but mortgages and credit also did well, returning over 2%. The managers in the mortgage and investment grade credit sector were slightly behind the benchmark by about 14 basis points for mortgages and 6 basis points for credit, and they were flat to the benchmark for the government sector. When we put this together, on the next page you see the returns for the program, and for the quarter the return was positive at 244, 13 basis points behind the benchmark. But for the year, the return was 537, while modest compared to Siemens equity results. They were over 100 basis points ahead of the custom benchmark, and it now brings the longer-term results into the 6.5 to even over 8% range, also ahead of the benchmark, and the volatility, as you see on the bottom, is in the 4 to 5% range. TIPS returns are on the next page. These are obviously government securities, inflation-linked securities, and so government securities did well, and the TIPS portfolio benefited on an absolute basis. Returns were negative versus the benchmark slightly, but the returns for the year were 717, and since inception, which we have a record going now back 6 years, the return is over 5.5%, slightly ahead of the benchmark. High yield results we've been talking about at several meetings on page 38. The results have been very strong, and as you see for the fiscal year, returns not only well ahead of the benchmark by over 150 basis points, but returning 16.21. On the 3-year column, you'll notice that the returns were over 300 basis points ahead, but more importantly, the results of 1159 are effectively now fully recovered from the downturn in 08. Spreads widened very rapidly, and over the period of time from 09, 10, and into 2011, came back into near or below average. And this also brings the long-term results into the 7.5 to 8 and even over 9% range. Convertible bonds on page 39. For the year, strong results on an absolute basis at 20.30, slightly behind the benchmark, or behind the benchmark by about 250 basis points. We added a new column to show what the results are versus each individual manager, because each individual manager has their own niche in the convertible bond universe, and we've been telling the board about that, and so we show how they show the program on a weighted average versus those benchmarks, and the managers have done well because we have talked about the anomaly of why are they behind the benchmark when they're outperforming each of their individual benchmarks, and this sort of shows that on the charts. We now have also a 3-year number, and even the underperformance versus the overall benchmark is narrowed in 3-year number because managers, as I've been telling you, did very well in the downturn in the second half of 08.
So Martin, when does this make us reconsider the benchmark? Maybe we don't have the right benchmark.
Yeah, we went through this when we came up with the program. We can talk about this more.
I'd like to. This is an asset class. I mean, it's only 1%,
Right.
so we should give it the relative attention. But This is not an asset class that I have heard anything about since I joined, so it would be good to spend a few minutes.
Sure. Well, one of the interesting things that came out of the RFP, and Mark may remember this, is that there is no perfect benchmark in this universe, and the benchmarks themselves are imperfect because of how in particular securities that run up in price have higher and higher deltas and become bigger and bigger parts of the benchmark, and a portfolio manager who would normally diversify would sell those as they go up, but they become bigger and bigger parts of the benchmark. So naturally, in a strong bull market, it's not unusual to underperform. And when we established the program, we expected that. On the other side, when the market's going down, we would expect the managers to do well. And so over a market cycle, we would expect them to do well. And that's why the 3-year number looks a little better. But we will certainly talk more about this. For opportunistic fixed income on page 40, the results show the new benchmark that was adopted by the board, which is the 10% return as well as a high yield plus a premium. And the results were extremely strong, returning over 24% for the year as well as for the 3 years. Unless you have any other questions, Kathy Martino has some comments on the ETI program.
Hi, good morning. Your ETI portfolio on the fees is a steady performer while it underperformed the custom benchmark. For the 3-month period, it outperformed for all other periods. So it's doing well. It's what we expect. The collateral benefits are in your board package on page 8. I'd like to just give you one highlight, and that is that the AFL-CIO Housing Investment Trust provided $134 million in financing for the Penn South Limited Equity Cooperative, which was built by the Ladies Garment Union in the early 1960s and needed some rehabilitation. The financing was contingent on the co-op remaining affordable, which it was due for at least the next 20 years. Those apartments are affordable to working families. So unless you have any questions about the portfolio, I turn it over to Yvonne.
Thanks. So moving on to real estate for the first quarter of 2011, just giving you some performance highlights for the quarter and also a little bit about the fiscal year. There's a 6% allocation, as you know, to real estate. At this particular point, we are 3% funded, and together with our commitments, we stand at about 4.3%. The market value for the portfolio was $1.2 billion. In terms of quarterly performance, we were right on top of the benchmark, 3.7% versus 3.8%. But let's take a look at the 12-month period where the NYCERS portfolio outperformed the benchmark significantly by 720 basis points, 26.2% versus 19.0% for the Odyssey benchmarks. The drivers behind this in terms of the managers that you have in place were Blackstone 6, City Investment Fund, and Walton 6. Also, during that 12-month period, we made $230 million in new commitments, 2 re-ups to new managers. The portfolio continues to be well diversified by property type and geography. If we kind of look at the metrics that are set up in accordance with the IPS, style-wise, we are 46% core, 54% non-core, which is certainly within the IPS parameters. Also the same in terms of LTV. We are within that 65% cap, and also within ranges for manager exposure. So in conclusion, we had a great 12 months. In light of the uncertainty facing us right now, we're going to be particularly cautious, but we have 35 investments in the portfolio, 26 managers, and moving in the right direction.
Okay, and with that, I'm going to spend a couple minutes on private equity, touch briefly about the market, and then just go right into the NYCERS portfolio. So if we look at the market today, larger deals continue to be the focus in the marketplace today. 50% of the money that's been invested over the past year has been invested in transactions greater than $1 billion. The real statistic to look at is the amount of dry powder, the amount of money that's sitting on the sidelines to be invested. Just to put it in perspective, year-end 2010, $410 billion. As of June of this year, $390 billion. So clearly deal activity is picking up, but still a tremendous amount of dry powder in the marketplace. With regards to fundraising, and this will continue to tell that story, it's hard to believe that there are 1,650 funds right now that are in the market looking to raise capital. It's the highest number ever recorded. They're looking to raise $661 billion. So a pretty sizable amount of money. The good news is not all those funds are going to be raised, and that is very, very healthy for the marketplace today. Again, to put a little bit more perspective, fundraising for 2010 was $110 billion, down from $168 billion in 2009. Peak number, $560 billion. So a significant drop off in fundraising. If you look at first half of this year and kind of just pro forma it out for the end of the year, it looks like this year will be on pace to do about $150 billion. Now if we touch a little bit on the NYCERS portfolio. If we go back to the strategic plan, the allocation for private equity was increased from 5 to 7%. Today, private equity is 7.4%, so slightly out of the band, but the portfolio keeps going up and down. As we've talked about before, as we continue to see some additional distributions, which pace is increasing, that number will move closer to the band. Return since inception, 8.7%. Total multiple, 1.25%. So again, increasing, but still significantly underperforming the benchmarks. We're, since inception, underperforming the Russell plus 500, 300 basis points. If we look at the one-year return was 16.3%. So on an absolute basis, an impressive number. On a relative basis, though, it underperformed the Russell plus 500, 800 basis points. We've touched on this before. Each quarter, when I give you these stats, we're going to continue to underperform the benchmarks. It's going to take us probably a year to 18 months as we continue to reposition the portfolio to start surpassing the benchmarks. The portfolio today, again, is quite vast. 126 partnerships, 86 general partners. If we go back to our policy, roughly 60 to 80% is the policy for buyout. We're at 76%. Venture, we're within policy, but as we've touched on before, not looking to do venture investments anymore. Roughly 10% of the portfolio. And the balance of the portfolio in distress, other mezzanine, again, in line with the target. We continue to focus on top quartile managers that we touched on before. We've committed to 4 new managers, EQT, BC Partners, AXA, and Pegasus. Those 4 managers have all closed. Those, again, are top quartile managers, writing larger checks or larger commitments to fewer managers. We think that's important. Also looking to help increase the European exposure. The last statistic I would put out there, if there's only one takeaway from this presentation, is the contributions and distribution numbers. If we look at calendar year 2010, contributions exceeded distributions, so the portfolio was net negative for capital, and that was roughly a 2-to-1 ratio, so a pretty large ratio. If we go to the first quarter of 2011, for the first time, distributions outpaced contributions. Again, it was roughly 1-to-1, a little bit greater than 1-to-1, but moving in the right direction. And I think in this marketplace today, if you look at it, private equity managers aren't selling. No problem in their own business. With that, I would leave it open if there are any questions.
Gary, is it possible to attribute that 16% across large cap, venture capital, etc.? So where did we do better relatively?
So large cap and mega is where we've done the best. We've significantly underperformed in venture.
So in last fiscal year as well, because that was a long-term trend.
It's very, very consistent. And I think when you look at the portfolio today, the challenge for the portfolio, we can talk more about in the executive session, is the mid-cap, where there's an enormous amount of concentration. While that portfolio should be performing better, it's underperforming. Thank you.
Any other questions about the year that ended June 30th? It was a great year.
Yeah, actually, I had a question for Rich. The emerging managers, the outperformance is so. Oh, I'm sorry. The outperformance is so.
Which asset class? I'm trying to figure out who you're addressing the question.
Managers.
SEMA.
I'm sorry.
Okay.
SEMA. The outperformance of the emerging managers is. Could you explain? On page 18. What is the? Did you have Why do you think they outperform the rest of the equity classes so significantly?
I mean, it's, again, there really is no individual thing I can point to. It is for just one quarter. It's not really a trend I could talk to.
Well, yeah, I mean, there was a lot of volatility in the quarter, right?
Right.
So how did they navigate? I think the question was how they navigated that.
They didn't
so
really.
Much better than the other asset classes.
The one manager that made some good changes for you is Progress in the quarter. The others have kept their portfolios the same.
Okay.
And what Progress did was actually something that we talked to them about, was with respect to how last year we reallocated money out of large cap and more into mid and small cap. They did the same thing. That helped them. So that was the one change to perhaps contribute to this. But I mean, all of them did fine. But that one, I would say, probably stood out the most.
Any more questions?
I guess I thought I'd put maybe an additional spin on this because I think it's worthwhile thinking about how in fact performance arrives, and you know, as you all know, we do performance work also. We put together reports for you all, and essentially our conclusions are exactly the same as Bam has talked about here. But I think what's interesting as we sort of chart the progress of how performance has changed over the years at NYCERS, there's really two components to your overall total fund performance. One is your asset allocation, and with a heavy equity exposure as you have, you would expect that over the past year in a good equity market you would have performed well. One of the very nice things to see, though, is what Bam talked about, and that is in all of our universes also top quartile for all periods up to 5 years. As you get out to 10 years, it's not quite as good. It's sort of third quartile for reasons that we all remember the fund struggled a little bit back then. I think the second part that's important, because every fund, as we talked about, has their own asset allocation. There's a second part that's really involved in implementing your portfolio. In other words, the managers that you all select, whether it's active versus passive, the individual managers themselves. And there's a couple of different ways we take a look at performance in there. One of them is a method we use where, in fact, we adjust everybody's asset allocation to yours, so that we put everybody on the same page there, and then we get at isolating the overall performance. And the interesting thing there is that over all time periods, you're top quartile in that also, which means not only have you asset allocated nicely, but in implementing the managers you've chosen, the way you've put together your portfolios in the major asset classes has been very contributory to performance also. As a matter of fact, as we break out the performance of each of your major asset classes, domestic equity, fixed income, and non-U.S. equity, in every one of those, you implement top quartile, or in non-U.S. equity, at the very least above median relative to other large public pension funds. And I think that's there's the different components that play through in performance. So I want to make sure that's not lost in this, that in fact both the asset allocation for you has worked over this period of time. There's times where asset allocation won't work. You'll be heavy equity at the time equity doesn't perform well. But the implementation is a major part of what you do, and it's been done well. So I want to make sure that doesn't get lost.
So could I suggest to my fellow trustees that we start looking very specifically at this report, maybe at least twice a year? So if we do it for June 30th and year end, this is relevant. It's a more granular and a better way to look at your performance. So if everybody agrees, I think we can ask Callum to bring that to the board on a semi-annual basis. I don't think we need to look at it every quarter.
Right,
That's just too
I
much.
would agree.
Make sense? Maybe we can do that.
Any other questions in the year? Okay. Let's go to the monthly reporting package.
Anyone need extra copies?
Anybody need a copy? So because we have a long agenda today, I'm going to try to be brief. I guess we, the markets, have drifted into a terrible place. It's not reflected in July results. It's reflected in today's newspaper. All of our charts show the same thing. If you remember, the charts were rolling sort of in June, May, April. Things were slowing down. We saw that in all of our economic charts. The big headwinds are in the United States and Europe. The biggest headwind in the United States is, despite huge cash balances on corporate America, somehow that's not translating into jobs. The U.S. had a very public debate in Washington about increasing the debt ceiling, lots of drama. The drama played out into what I'll call extra innings. The extra inning is the U.S. has to figure out how to get its debt under control. That will play out in the special committee that's been set up. They'll report back in November. My guess is whatever they do in November will not be satisfactory. And my prognosis is that all of that sort of muddles through until the presidential election. Not to say the presidential election is the end of the end of things. So I presume that there's a large muddle in the U.S. economy with a lot of people looking to fiscal policy to fix things. So you have that, and that's not confidence inspiring, and when you don't inspire confidence, people don't spend their money. If people don't spend their money, the economy rolls down. Over in Europe, they're still trying to deal with the mess that was partly created in the United States. Let's call it the financial crisis. They have been unable to resolve it. They're unable to resolve it because, unlike the United States, where we have a country that has fiscal and monetary policy in Washington, D.C., they have they have monetary policy, which is a collection of 17 countries trying to figure out the euro, and they have 17 plus peripherals, 23 countries that do their own fiscal policy. So they can't make a decision. You can't make a decision. They have too much debt. Greece, Italy, Portugal, Spain. People look to the stronger countries to bail each other out. Maybe it's coming, maybe it's not. Their banking system is much further behind fixing itself than the U.S. banking system was. Some of the banks in Europe mark very simple loans very, very differently. So, for example, some of the French banks have the Greek loans marked at 80 cents. Some of the German banks have it marked at 50 cents. The reality is probably lower than both. If you mark all the market, they'd all need capital. Where are you going to get the capital? No one's really dealing with it. That's a problem. So the fact that you have a problem in Europe and a problem in the United States, with drifting in the United States, is very good. Emerging markets slowly start to slow down, and before you know it, you have a complete loss of confidence starting to erode the global economy. The Fed can take actions. It took some actions this week. QE3 with a little twist, and I'll show you what that means in the numbers. But the reaction to the markets was pretty dramatic. They're down 6% since the announcement, so that wasn't a very good vote of confidence either. So we've got this very, very bad set of dynamics that is not fixable in meetings. So by that I mean, if you go back to 2008, everybody would watch Bloomberg News on Sunday evening before the Asian markets happened, because something would come out of the Treasury or the Fed and things would happen. Less happening, more drift, not good, weighing on our portfolio, which you won't see in these numbers. So I'll be pretty quick on the July results, but you will see in the September numbers. You will see in the August numbers, and I'll give you a little highlight as to what that means. I don't mean to press all of you, but this is not good. We had great results last year, up 23%. This is not going to be up 23%. We have a whole year to figure it out, but the markets will not be cooperating for most of this fiscal year. If you jump to page, I'll skip all the economic charts, but they all kind of get you to what I just said. If you go to page 22, is the Treasury yield curve. So the Fed worked very, very hard to drop short-term rates, which they did successfully in QE2. The Fed, again, can act, whereas fiscal policy is more of a negotiation. So the Fed came out and said, all right, we've done a great job buying all these shorter-term things. We're now going to sell those or let them run off and reinvest the money and buy longer-term things. So if you look at this chart, the white line, you'll see the white line is the lowest line until you get to about the 10-year number, and then it crosses. Let's just say it crosses the way it was coming out of our crisis. The Fed is going to work to lower that line. They're going to lower that line on the theory that dropping long-term rates helps consumers refinance mortgages, and refinancing mortgages will get rid of the mortgage overhang, and you'll slowly start to get people to spend. That's what the Fed says.
Well, we're already there. The 30 years at 280.
Right. Who might argue with the Fed? At some point, though, the Fed's trying as hard as it can. It has lots of powers, and common wisdom is don't fight the Fed. They do have the printing presses over at the Treasury, and the Fed's got trillions, billions of dollars. That said, the markets, or the voters, they voted. They're not quite buying the whole thing, but this is going to happen. Rates are coming down. Rates are coming down to us means our existing bond portfolio goes up, so that's good. But until the economy gets started again, and again, people refinancing their mortgages, in theory, is supposed to cut the amount of money that they spend for their monthly mortgage payments, therefore they have more money to spend elsewhere. Well, the presumption is they have jobs. So unless you fix the job problem, this is, in my opinion, around the edges. It's positive around the edges, but it is not dispositive as to what's going to happen. So the good news is they're trying. The bad news is there's so much other stuff. The other stuff has to get resolved. The euro, European crisis, what's going on in Washington. So they're trying as hard as they can. Good, but not an answer. But right, they're trying to help. So again, rates have come down. The 10-year Treasury is at 1.74%. I don't know if you guys are all lend money at 1.74%, but that seems a little low. And the 30-year rate is now down to 2.8%. So these are the lowest rates ever. So forget about inflation worries and stuff like that. They're working very, very hard to keep rates down. That has a negative effect of crushing savers. Because savers, retired people who live off of income, and maybe their bonds, they're not making as much money. So very complicated. We can have hours and hours. We can bring all the experts, and maybe we will over time. But this is a problem that if we go back 6 months, everybody thought we were coming out of a recession. I'm not saying we're going back into a recession, but the growth rate, again, if I go back 6 months, we're saying 3.5. Now the growth rate is 1.5, 2. Slowing down. You need 3% growth rate generally to get jobs up. So we're just in a very bad place.
It doesn't look like it's going to be resolved.
And it's not going to be resolved over the weekend in a meeting, the way the other stuff tried to get resolved to go back to 08. So I would tell you, so we've done a variety of things to try to deal with it, but this is very complicated stuff.
Summarize those.
Yeah, I'll show you exactly. I'll summarize more in executive session, but I'll give you the quick highlight. So if you go to page 24, for instance.
Larry, I have a question about
Yeah.
the Fed lends money to European central banks,
Yeah.
and that doesn't seem to do much either.
Well, what happened, and I'm glad you brought that up. So there's a lot of very, very complicated things going on. One of the things going on is lenders were starting to get worried about the condition of foreign banks. French, Italian, Spanish, lesser extent German. And a lot of these banks fund themselves, I wouldn't say like Lehman, but a little bit like Lehman Brothers, short-term basis. So they would fund themselves with commercial paper in Europe and commercial paper in the United States. And the commercial paper in the United States is dollar denominated. So they match their dollar denominated assets here with dollar denominated funding. What has started to happen in July and August is American lenders said, I don't want to buy that commercial paper. Well, if you don't buy it and you can't roll it, you have a liquidity crisis. So people in the U.S., people stopped buying European dollar-denominated commercial paper. A couple of the banks went to the ECB and said, I can't roll my paper, I need some money. They issued $500 million over a couple of days. And all of a sudden, the monetary authority said we can't have a liquidity crisis like we had back in '08. So the Fed got together with the Fed, Bank of England, the Swiss Bank, and the Bank of Japan, and said, we guarantee it all. Take that risk off the table. The problem is they said that we're going to do that for 90 days. So for the next 90 days, all that paper is going to get rolled. Fine. Stay tuned to what happens on the 91st day. But that doesn't inspire confidence. It does solve the problem, but it just basically says, gee, that really was a problem.
It's a Band-Aid.
It's a total Band-Aid.
And the investment banks are not taking it.
They have to sell to somebody. They don't hold the paper.
Well,
Right.
the crises passed, they've held the paper.
So the investment banks are all, everyone is sort of going the other way because there was worry about the condition of the European banks, and now what's happened is, that worry was right. So, again, more to it, but you're right. That was last week. So, again, there's that last week. There's the Fed coming out with twist this week. Lots of things. People are trying to keep the game going. But at the end of the day, you need 17 countries in Europe to agree. Difficult. Very difficult. Huge volatility. There's a chart here on the VIX, bouncing around again. Lots of things. So you're back to pay attention every day what's going on in the markets. So to your question, and I'll jump to the conclusion, what we've done is on page 33. So you may recall that, again, this has been building, it doesn't happen overnight, so you have to kind of do this on a cumulative basis. You may recall last spring we sold high-yield bonds. We didn't reinvest the money. And we've been taking money out of equities. And we took a little bit of money out of 4+5 very recently. So in July, we had, it's the gray bar, about 6% of the fund in cash. Okay? We've since taken out another 3% in cash. So now we have about 9% in cash. People call that de-risking, which is what I would tell you was a good thing to do, because I can't tell you which of these markets you can make money in today. It's a little bit of, I don't think you make money almost any market on a daily basis. This is very dicey stuff, so I think in the past we used to keep our liquidity in the stock market. This is not necessarily a good place to store things right now, so it's in cash. And if you go to page 33, we are in the process of switching because the board's agreed to a new asset allocation on page 34. So it's actually not a bad time to be harvesting cash because we're in a transition period in our own right. But it's the wrong time to be making long-term investments when the seas are so choppy now. So we tried to take risk out of the portfolio. We have about 9% in cash. So when the markets go down, the way we've kind of just pulled chips off the table, if you will. Ultimately, we'll put it back. We'll keep talking to everybody as to what's going on. But other than that, well, that's what, in my opinion, that's what we're supposed to be doing now, is taking risk off and let things heal and not make long-term investments. So that's what we've been doing, to answer your question.
So before we move on, let me take the other side. I can't help but wonder if at this stage equities aren't the cheapest asset class out there.
They are.
We've seen carnage. So why be in a hurry to move? I understand that relative to the new asset allocation, we are out of the bands on the positive side. But why don't be in a hurry to keep de-risking out of equities when in fact they might be the cheapest thing? And could we actually see a lot more on relative valuation between stocks and bonds and within equities, U.S., non-U.S., because I think it would be very illustrative. And I would suggest that we pause on the de-risking because 9% cash, I'll come back to that when we talk about rebalancing ranges, is a lot of cash.
Yep.
And if anything, if you keep de-risking, we'll sell the cheapest thing out there at this point. And I'd like to understand that. I'd like to understand valuation before we make further moves.
Well, stocks are cheap.
So,
Might get cheaper. If
Sure.
you look at our asset allocation that this board agreed to, we're over-allocated in U.S. equities and EFO. We have a lot, as we'll talk about later, we have an awful lot to rebalance on a long-term basis. Upwards of 35% of the portfolio, you're switching from the old to new asset allocation.
but it's a
I think-
long-term plan.
It is a very long-term plan, and we're not trying to time markets either. What we're trying to do is manage risk, I guess. And I take your point. We're pretty much done de-risking. Again, we didn't. It's not like we had a crystal ball and thought the markets would go down 5% yesterday or 3% the day before. But looking back, that feels pretty good that we de-risked it. So we're trying to be in a flexible position. There's some charts in here to talk about valuations. Stocks are cheap. Stocks also get cheaper if there's a big recession.
The question is it priced in? What is priced in? And, you know, there's a huge hit in earnings priced in at this point. A lot of people would argue that it's... I'd love to delve into that a little
Sure.
bit more because I don't understand the relationships between large and small U.S., non-U.S. But what I'd be very willing to consider, and we should as a board, is interim targets. So between pages 33 and 34, we have our current and our new targets, but we can't not have an eye to what's just happened in the markets.
Or have
Mark?
a
Yeah, I guess one thing I need to consider, I think this is a broad topic that needs some study. But I guess as I take a look at 34, there's a couple of things I note. One is that hedge funds are under-allocated naturally by 3.4% because you just started funding that. Real estate is underfunded by 2.8%. We've talked about needing to fund that up. One of the things that we'll be talking about a little bit later is what are the appropriate holding places for assets you're ultimately going to place in there. And one of the things that we've suggested is that for both of those areas, a combination of equity and fixed income really makes the most sense. So one of the things we take a look at here is we're showing domestic equity over-allocated at 7.4% relative to the new target. By the same token, two asset classes, real estate and hedge funds, are under-allocated by 6.2%. If you consider half of that as ultimately maybe a holding place would be equity, you reduce your over-allocation to public equity by that 3%. So you're not quite as over-allocated as you might look. And again, it's in an area that you're bringing down over time. So I think there's a number of different aspects to this that we need to think about. But I think the idea of moving gradually toward your new targets is what is naturally going to occur, and I think part of what takes place as you begin to look to get to those new targets. So I think there's just a number of different aspects need to be thought about in this.
You bring up a good point, Mark, and that is the hedge fund program, which we're going to talk about, has done exactly what it was supposed to do. From Kamal, a perfect cushioner to the decrease. And Seema's going to report later as to the progress we're having. But so we made the right decision. It takes time to do it. The question is, where do you put your money in the interim? So some of that cash, if you will, is taking it out of a riskier asset, waiting for you to have a place to put it. The same thing you're going to hear later from Martin on optimistic fixed income. Got some great managers. We're in the process of moving it. It looks like the perfect time to move into optimistic fixed income because Europe is having issues. They're marking down loans. It's very undervalued on a longer term basis. So lots of opportunity. So we're kind of at the right place at the right time with very, very good managers. So some of that cash is really just earmarked, if you will.
Some of that cash.
Absolutely. Yes. So it's kind of in process. I would tell you that's probably upwards of 3%. So a third of the 9. It's very, very earmarked. But we should have more conversations about cash and de-risking and where we are. And again, we're not in a hurry to get to these long-term targets, but there is a We are slowly moving from page 33 to 34.
The other thing that seems to come up in my mind in this discussion is that, you know, all the dry powder that we have on the private equity side, it's basically cash too, because it's not being spent.
Right.
So that cash number in my mind is even larger than the 9%. But if it sounds like we could deploy, you know, the cash we have in our bank accounts relatively, or at least a good portion of it relatively quickly.
Yeah, to Barry's point on the private equity, again, if you look back 3 months, and the reason you have all these private equity funds coming to market at the same time is they've been unable to have realizations. Because the market had a recession, markets had to catch up, markets caught up last year, everyone has all these companies, they got to get us back the money so we can reinvest in their funds. So there were a bunch of IPOs in the pipeline, some M&A things in the pipeline. That just stopped. Just stopped because the markets are a mess again. So money coming back is going to slow again. They are going to, the money going out might slow because in bad times it's a good time to actually buy something if you can get the financing. So again, the flow of our private equity dollars is going to probably be more out than in, even though the people who were fundraising would like it to have been just the opposite, and it was just the opposite, as Barry pointed out, as recently as 3 or 4 months ago. So again, all the markets are coming about in very, very volatile times. So, and which, as we just to keep going, isn't going to be reflected in these July numbers. Because it wasn't July that was the problem. If you turn to page 37, these are the indices in July. So the stock market, the U.S. stock markets were down 2 or 3%. International markets were down 1 or 2%. The high yield market was actually up. So July was all right. Just to go back to page 36. So the fund lost 1% or so in July. Okay, not so bad. These are the numbers. However, if you go to page 38 and look at again the first column on the left, well, we were in August. The markets were a mess. The markets were a mess in the U.S. They were down 5 or 6%. Internationally, they were down 8 or 9. The high yield market backed up 3 or 4%. In September, they're also a mess, right? So these numbers are ancient. So July was okay. Storms in August bounced back. In fact, if you look at the stock market chart, there's an awful lot of up and down and up and down. But my guess is September is not going to be a very pretty month either. But these are July numbers. So if I flash forward, we're probably down 5% from these numbers, the July numbers. So the first quarter, you know, it's a little bit of, we got a roughing the passer penalty in the first quarter here. So we're dropping back instead of going forward. We'll see what happens in the second quarter. But the first quarter is pretty much baked. So that's sort of a rambly way to get you through this book. And the managers, to your questions before, the managers have done what the manager's supposed to do. But in July, it was all right. We'll see what happens in August and September. But as markets bounce up and down, we get more and more volatility and variance amongst our managers. But again, we're diversified, so we're making money on the bond side. In the core plus 5 side, we're not making money in high yield because spreads are widening because people go to quality, and we're not making money in equities because stock market's going down, and hedge funds are doing fine. So that's sort of a big overview. But we're back to tough times to make money. And to be honest, rather than bang through all these July numbers, which are completely old, I'd be happy to take any questions on the July results, because the July results are what they are, which is fine.
A quick question, Larry. So are you seeing a flight of money to the hedge fund space as these folks, that's sort of their business to manage?
I'd say yes and no. I mean, there is money going to certain strategies for sure. Not so much in long-short equity because of what's going on in the equity markets. But the macro managers, those who trade currencies, interest rates, based on economic trends they see throughout the world, those folks have actually done quite well. I mean, many of them were up in August. One of the ones that we're actually considering for a direct investment was up 6% in August. And so, there have been some managers that have really shined through this period, and a lot of money is going that way. We'll see how it plays out through the year, but at least there are certain strategies that we've been looking at that, because they're tactical in nature, and that's why macro managers fall into this bucket that we've been calling tactical trading. They just follow the trends in the market, and they can move quickly. They're very nimble. So as they start to see markets going up, they'll start shifting their portfolios appropriately. So those right now, I would say, are probably the ones that are doing the best.
Maybe a couple of additional things. Just as a trend, one of the things you want to recognize is that there's been, just as there was a tremendous move toward diversification, further diversification among pension funds, and primarily large public pension funds like yourself. And so, as a result of changes in asset allocation, there are significantly higher allocations being made to hedge funds and other alternative investments. So there's a natural funding that's going to take place from that. I think the interesting thing that's going to be interesting to watch is what happens as we go through months like we have in July, August, September, as new investors in these asset classes sometimes expect more out of them than they might be able to deliver in down markets like this. And so in a down market of August, where the equity market is down 5%, hedge funds in general are probably down an average of 1.5% to 2%. Now that's much better than equity, but it's not the absolute positive returns that some people might be expecting. And so I think the reaction to that, like back in 08 and 09, is going to be interesting. But I think most of this that's coming in is sort of destined as long-term type of money, and so I think it will be funded, and then people like themselves will wait and see what's going to do.
I can tell you, SEMA is going as fast as possible to find our first direct investments in hedge funds, because again, the plan was right. We need to have hedge funds to dampen the volatility, and between now and the end of the year, she's going to bring us the first series of direct investments. Not soon enough. But again, between the cash, the hedge funds, the fixed income, and the opportunities of fixed income, we're diversifying to stuff that's, in theory, less volatile.
And as much as we think we have a great program and plan for opportunistic fixed income, as we're talking to more managers and plan sponsors, we're learning that other plan sponsors are taking our lead and are also looking to do what we're doing as well. But we're a bit ahead of the others, as Bob North likes to say, first in gets some premium to collect. So we are pleased that we were able to arrange this plan to move forward.
And we'll talk about that also in executive session.
Right.
So fasten your seatbelt. A little turbulence.
So could we have a broader, kind of deeper conversation on valuation? If you want to bring someone in, to some strategist in who talks about things about that, that would be very helpful.
Okay.
Instead of an economist.
Okay.
And also just on these charts, I actually didn't see cash at the bottom. So on pages 33, 34, it's in the pie chart, but I don't see the 6% allocation in the relative mix.
What page?
Just 33, 34.
Yeah, all the pie charts here.
Yeah. What's in the gray is in the pie charts, the cash, but the relative difference
The
will
dollars.
jump out and it's just not on the charts.
It's on page 30. You're right. The relative difference in cash isn't going through. The number's on page 35.
The relative nature of cash is important. The normal allocation is zero.
Well, so I want to address that when we talk about rebalancing, because I do think Larry said at another meeting that, because I brought up this 9% cash is a huge bet by Van. I'm very surprised at that it's such a big number, but apparently we don't have a policy around it. So as a board, we should set a policy around it. And also a policy, I think, on these interim interim vents, because we're out of the transition from the old to the new needs to be cut through so that VAM is not outside policy.
Okay, for the results? So now we'll talk about rebalancing.
In your package, starting on page 91, is a memoranda that we actually had been working on for over the period of a month and a half. And I think, I want to put into context that there's really sort of a number of questions that were raised around the issue of asset allocation as we went through the process. And I think in this memo, what we tried to address are what we viewed as the major ones. I guess I view today's presentation as a discussion primarily. There may or may not be a decision to be reached today. Ultimately, I think you need to reach decisions on certain things, but this is the first time that we've come to you with sort of our thoughts on what we thought are the major issues surrounding sort of subcomponents of asset allocation, holding places, and rebalancing policies. So I'd sort of open with that in mind. And I think while there are 4 points in here, there are 3 key ones. The first is the issue of, within non-U.S. equity, how much of your allocation might you want to allocate toward developed and non-developed or emerging markets. Our approach when we do asset allocation is that we much prefer looking at very broad asset classes and not sort of allocating among sub-asset classes or smaller asset classes. So as a result, in our asset allocation, we didn't come up with a formal allocation to convertibles or a formal allocation to REITs. Within non-U.S. equity, we didn't break out developed and emerging. We'd much prefer that be handled more in a qualitative, fundamental way, as we're going to talk about today. So I think in our mind, there's a number of different ways to take a look at how do you decide how much you should have in emerging markets equities relative to developed equities. And there's different things to take a look at. One is, how might it be optimized if you did it in asset allocation? Another might be to take a look at, all right, what's the breakdown of capitalization between emerging and developed? An important one for the New York City systems is, what might you want to try and get to because you have another constraint that's naturally imposed on you, and that is the basket clause. So part of asset allocation work is figuring how best to use the basket clause, but within that, non-U.S. equity is a particularly interesting one because anything above 10% in non-U.S. equity counts toward the basket clause, whether it's developed or emerging. So is there sort of a natural approach that you might want to take where you fundamentally decide that, yeah, I recognize that we have both, but we want to get a little bit more bang for our buck in emerging markets than in developed. So all of these things come into play as we think about it. So ultimately, what we've suggested in this document here is that as we put together all of those thoughts, optimization, market capitalization, basket clause, etc., we think a natural and as well as the fact that you have a 5% allocation now and you've been in it for a while, we think a natural place to fall would be somewhere in the 6 to 7% range of emerging markets. We, in this document, suggested 6.5, simply because it's the midpoint of that 6 to 7 point range. But we think that something around that area makes sense. That would indicate an allocation to developed markets of somewhere in the 10% range, to emerging markets somewhere in the 6 to 7% range. Again, there's not a magic formula that gets us to that, but I think through the discussion that I just gave, that's sort of the thought process where we would come down to somewhere in the 6 to 7% range in emerging, with the rest to developed. There is certainly room for discussion around that, but it seems to us that's a good place to try to maybe think about ending up from our standpoint. So I think that's the first topic in this document. The second, and I think this was actually Ranji that specifically asked this question, and we put it in here. In our asset allocation, we targeted a geometric mean return, and geometric mean is sort of an annualized return over time. It reflects the fact that some years are above your expectations, some are below, and so over a 5-year period of time relative to 10-year, we expect the returns to be relatively close, but there is, because of the factor of how you geometrically calculate returns, or returns are calculated, a slightly lower expectation of returns over a 10-year period than over a 5-year. But essentially, I think that's a marginal difference, but I think it's something that we were asked and wanted to include. The third point is one of the ones we were talking about earlier, and that is, it's going to take a few years for you to fund up various asset classes. The area of opportunistic fixed income, hedge funds, private equity, although that not as much, and real estate. And so there is a question that needs to be addressed: is what do you do in the interim with the assets, recognizing that that your long-term target is to have your assets in those asset classes, but you're not going to get there for a period of 6 months to a year and a half to 2 to 3 years in some cases. And so what do you do on an interim? This is something that in really 3 of the asset classes, we've had pretty standard recommendations for clients over time. In the area of private equity is equity. And so we think that a natural holding place for private equity is in your public equity portfolio. That would be either domestic, or in the event that you expect that some private equity assets will be invested outside the U.S., that could also encompass keeping some of it outside the U.S. But a natural holding place, private equity is equity, and so we think that that is a natural holding place for assets that will ultimately be placed in private equity. Now, you are essentially close to fully funded in private equity, but you're going to continue to make commitments. So this may not be an area that you need to think about too much.
The only puzzle for me there is that the commitment does not change with markets, right? So the commitment amount, which is over a 2 to 3 year cycle, say, is a finite amount that has zero volatility.
Mm-hmm.
So having equity volatility against a liability that is a sure thing over the next X number of years, I don't know how to think about that,
Mm-hmm.
but that's the only thing that troubles me. So if we're in this current market and we're down 15% and a commitment comes due, that's 100% still. You see what I'm saying? So it's once you're invested, the asset classes have similar volatility and private equity has more, but we are actually holding this against the commitment, not against value. You see what I mean?
And Ranji, I think that's, maybe gets to a distinction that I hadn't really talked much about in here. Presently, you're funded to a 7% level. Now, you have unfunded commitments that, in fact, will later need to be invested as the money is called. However, during that same period of time, you're expected to have distributions that, in fact, you'll be taking and needing to reinvest. So I guess the starting point for this is, to the extent your private equity commitment or allocation is 7%. If you were at 5% fully invested currently, then we would say an additional 2%, which is the difference between the 5 and the 7, should be invested in public equity. We're not saying that future commitments or commitments that you've made that are unfunded should be held in public equity to overweight equity further. Because part of your future contributions to private equity is coming from distributions that you'll be getting from private equity.
Okay, that's an important distinction.
So I guess that's the point where I'm saying in private equity, this type of decision probably isn't one you need to make, because you're already at that current level. Where it comes into play more is in real estate and hedge funds. The practice in the past has been that any real estate underfunding that you have, you presently held in equity. We think of real estate as a combination or a blend of equity and debt, yield and capital. As we do asset allocation, we typically draw real estate from a combination of equity and debt. And so our thought in real estate is that the holding area for the 3% that you are underfunded now in real estate should be held in a combination of equity and debt. We would suggest core plus 5, as well as public equity. Again, could be global to the extent that you're allocating to global in the future. But the blend should reflect what you expect from the asset class over time, a combination of yield and income and capital appreciation. Yeah, Martin. REITs. Yeah. Martin mentions REITs, and that's a little different space for us. We are not your real estate consultant, so I preface that with this comment with that. In situations where we are the real estate consultant to funds, we very often will have REITs as actually a direct part of a real estate portfolio. That may or may not be where this fund goes over time. However, REITs can also serve as part of the equity component of a holding place for this. So that is also something else you could think of as part of the equity component of where you look at things. All right. Hedge funds we think of certainly not as the same as real estate, but essentially we also draw, as we do asset allocation, we draw hedge fund allocations from both fixed income and equity. And we think a natural holding place for equity or for hedge funds that will ultimately be funded up is also fixed income and equity. Now, as you see with that, what that ultimately during this funding up period leads to is a higher allocation to both equity and fixed income than you might have approved through the asset allocation, but it's made consciously as a holding place for money that is ultimately destined for those other asset classes. So for us, for our clients, those three asset classes have been fairly standard areas that we've suggested they might want to consider for money that will ultimately be placed out in other asset classes. The real challenging area is opportunistic fixed income. What do you do with the 4%, or now I guess it's probably about 3%, that ultimately will be headed to opportunistic fixed income?
Especially at the time that we're reducing our overall high yield.
Exactly. There really are fundamental discussions that could take place that opportunistic fixed income may be most like high yield, and so that's a natural place to hold it. But at the same time, you're reducing high yield, and so is that some place you want to hold it? We also think that to some degree, there might be a higher correlation with equity than you have with other fixed income allocations. And so equity might be a place. However, equity is also an area that you're reducing. Overall, we've talked about, to some extent, diversifying and de-risking the portfolio. So there's arguments for and against there. The other area is hedge funds. To some extent, opportunistic fixed income is another form of active management where the manager is making conscious decisions about where to go. And so there's sort of a natural holding place there. The last area is fixed income. And and I term investment grade fixed income. We think that there's a nice degree of symmetry to hold some of opportunistic fixed income in investment grade fixed income. The reasoning behind that is that very often the time that opportunistic fixed income appears most attractive is during a time of market stress, when liquidity is an issue when in fact the area that might be rallying the most, as it is now, is investment grade fixed income, treasuries. And so we think that there is a natural symmetry that can take place by holding some portion of your opportunistic fixed income in investment grade fixed income. So the area of opportunistic fixed income is one that we don't have as clear cut an idea for you. We think all four of those areas could be considered. We would lean more toward a combination of holding your opportunistic fixed income allocations in investment grade fixed income, potentially some in equity, but also potentially some in hedge funds to the extent that you have enough hedge funds to fund that extra degree. But we do think investment grade fixed income is an attractive area to hold assets ultimately destined for opportunistic.
So Larry, part of what I'm hearing makes me say that we haven't seen, we know that Martin and Seema are working as hard as they possibly can, but it would be very helpful to have a bit of a calendar on when you think you guys are going to get invested, because it almost seems like opportunistic. You could get there pretty fast based on the slugs you're doing. I don't have a sense for how long the cash is on the books and not before you guys deploy.
Well, I'll give you a sense. There's two different timing algorithms. The one is hedge funds. The good thing about hedge funds is when you pick them, you basically send them the money and you're investing. Opportunistic, you select the manager, negotiate a document, which actually takes a little longer than hedge funds, and then they probably bleed it in over 6 to 9 months. So picking the manager, you don't have the money deployed for a while, which is a real problem because we'd love to have it now.
Right.
So again, we're going as fast as we can to get the managers. SEMA's is better because we get the managers, we give them the money, and it gets invested within 30 days roughly. So between now and year end, SEMA, what would you say we're shooting for? Not to get you good and pregnant, but we're pregnant anyway.
By calendar year end,
Calendar year end.
we would hope to be close to having a total of about $2 billion in hedge funds
So we've got,
across
So 40%.
the three systems.
yeah. So we've got this backlog of things that we're in the final stages of diligence on with Axia. So that money, if you presume we get board approval in December, the money could be invested in February,
Right.
right? So that's $2 billion of the, and let's just assume for rounding purposes, $2 billion is 2%. So it's 2 of the 9. It goes right into hedge funds. It does what it's supposed to do in hedge funds. And then the following 12-month period, because we think in calendar years, you do another $2 billion-ish. Sort of roll it out. So we'd like to think that we have the hedge fund money pretty much to work in 18 months. Right? Mm-hmm. The fixed income, the opportunistic, again, it rolls out. We've got a queue of managers. I would say probably within the same 18-month period, we'd have the managers picked and the money to work.
Certainly within 18 months.
Right? Because again, they get much more diversified longer. It just takes them longer because of the way they do their business. Some are a little quicker than other guys. We'll talk about that when they're here. But I'd say both of those plans get invested in 18 months with the more front end from the hedge funds, a little more back ended with the opportunistic fixed income.
So then let me go back to Mark, because I'm still stuck. I completely agree with you on a steady state. When you have a 7% allocation, contributions, withdrawals, you know what to do. But here we have a very finite liability, 5% of our portfolio, actually more, over an 18-month time period. I mean, you wouldn't be in equities with an 18-month time horizon, never mind that the VIX is trading at 40%.
Mm-hmm. Yep. No, I think that's you bring up an important point, and that is one of them is the timing aspect of things. And at what point does short or immediate or close to immediate funding begin to translate into intermediate and longer term funding?
Because of the magnitude of the changes we're about to
under-
make, right? It's
understood.
just an odd time.
I think from our standpoint, clearly up to a period of, I would throw out the time period 3 to 9 months, to the extent that, for example, the hedge funds that Seema talks about are going to be potentially funded over a 12-month period. Clearly, I think
18.
no, a good portion in 12, but then onward to 18. I guess what I'm trying to distinguish between sort of a short-term time period, which I think we define as sort of a year or less, than a cash holding place or a liquidity holding place makes some sense. As you get beyond that, I think I would agree, Ranji, you're not, for an 18-month period, you're generally not going to hold equities. However, at the same time, you're already there, as we saw earlier. Part of what you're doing is also a gradual drawdown from your current position. And so if not a blended, balanced portfolio of, let's say, equities and fixed income, what might the alternative be? It could be an intermediate fixed income position with a modest duration of a year and a half. You can certainly go further into that, and I think that was part of what we wanted to get with this discussion, exploring other areas. Clearly, I think we're directing our where do you hold things toward a time period such as real estate will be of a 3-year time frame. Some of what hedge funds may be beyond 18 months. But that shorter time period, I would agree with you, that that doesn't necessarily apply to this. So,
the rebalancing range that you're talking about in general, of course, what I'll call a steady state portfolio.
Mature,
right. So we're not steady state at all.
At this point.
At this point. First we were switching, and then the markets went crazy. So you kind of caught us at an odd time. So de-risking and getting ready is sort of, I think we're going to wake up in 12 months and sort of find ourselves in the right spot.
But I think that's what I'm saying. I think we're having two discussions. We have a policy discussion, and then we have an interim policy discussion.
That's right.
But the key to me is to make sure that our risk and our exposures are managed by within bands that the board is comfortable with from a risk. And then to the extent that we agree, for example, that we need 5% cash for funding purposes, not liquidity, then that should be in the policy benchmark on an inch for the next year. So I just want to be sure that, because I think we paid way too little attention to the difference between our performance and the policy benchmark. I'm trying to change that, but only if BAM has the right policy benchmark to be measured against. But
yeah, on this whole discussion, I think you've touched on a lot of it, but I do think there's a question here of overall strategy/policy versus tactics, which is a time frame, long-term versus short-term. And in the strategy, I see there being two elements. There's what are you trying to accomplish with the asset class? And I'll just give an example. I think the reason the equities have been the parking place for some of the uninvested assets is because they're thought of in the what has previously been the 70% equities bucket. So they went to equities. Strategically, one can decide, if real estate is equity real estate, that's where it's gone. One has to decide there are the characteristics of the asset versus what are you trying to achieve with the bigger policy, and then just decide amongst yourselves which is preferable and then settle on it. And then you pick the ranges. And ranges, mathematically, you rebalance by comparing the expected standard deviations of the portfolio with the asset class and the correlations and the liquidity and the rebalancing expenses. Another thing about equities is they're cheap to rebalance into. And you have to deal in particular then with the illiquid assets and give them their own special treatment. We know about the denominator effect from a couple of years ago. It's how private equity burst way up. It's a lagging value, and it, when everything else goes down, it's what. But in terms of the discussion, I think if you've got the long-term strategy, you then just have to leave room for the tactics. If it's going to be an 18-month period to go into hedge funds, for example, that are going to require a cash draw, to what extent you can get cash by liquidating equities, which might be up, they might be down. Or you can have cash and you know exactly what you got with no return. You get certainty out of the latter, and you have opportunity gained or lost out of the former. And the board just, I think, has to be comfortable with the kind of direction it would like in terms of providing some guidance, because this happens almost on a day-to-day basis. And I would hope the board could set the strategic goals of the rebalancing policies generally, philosophically, and then be willing to accept that the Bureau of Asset Management has a day-to-day challenge of people are going to call money or they're not going to call money, as well as, of course, every month you're busy finding $100 million to pay benefits. So,
150.
okay.
It's $1.8 billion out a year with NYCERS.
I'm
Really
working on
six.
cutting that down, Larry.
So the one thing, though, that you must accept is what we have learned in the last long-term asset allocation exercise is what 70-30 deems as 70% equities today includes asset classes that we have deliberately sought that have a 10% volatility and mixes it with asset classes that have a 20 to 30% volatility. So equity doesn't actually mean anything to me anymore the way it's been historically defined. And that's the struggle, that's the rebalancing challenge.
Oh, I agree
So
with you.
I just can't, I urge us not to be bound by historical definitions of equity and fixed income because that's where we sort of have had exposures as a result that have exacerbated the risk of the portfolio.
No, but I think that shows that you, in thinking about it, are thinking in terms of on a strategic basis, it's more important to establish your rebalancing concept and parking places by referencing the financial characteristics of the asset classes to be funded as opposed to the buckets you put them in. And that's fine. That helps in it kind of where Cliff was coming from on
Cliff.
I'm only a few years old.
Yeah, you don't even know what that did to me.
Okay, that's good.
Thank you, Bob.
Duration to retirement date, Bob. Any other?
But just to continue what Bob said, that thought went into what we do.
Well, let me see if I can summarize. We don't have to bring us to a conclusion today, right? This was an ongoing discussion as we're trying to come up with the new ranges for the asset allocation. Forget the cash for a minute, because again, going from whatever the page was, 33 to 34. 33 was pretty straightforward. We got to go to 34. We got to get reestablished ranges. We'll be back next month with here's some ranges for the boards to approve. We don't, unless anyone wants to keep talking about this. No. Perfect. Okay. That ends the public session.
Okay. Do I have a motion to go into executive session? Second? Second. Okay, you want to vote? Oh, our attorney is raising her hand.
Yeah, I just wanted to bring the board's attention that we have.
Wait.
Wait, hold on.
Unplug
Can we make
things.
sure the cameras are off before you speak, or do you want to speak? Are you in the public session or
No, I
executive?
just wanted to request an attorney-client session.
Okay. Okay, so let us still continue to move into executive session. So if you can turn off the cameras.